Okay, I think I'm going to go ahead and get started. I'm sure folks will kind of join us as we go along too. So, perfect. Okay, so hello everyone. I'm Heather Rodemaker-Taylor with First Nations Owista. I'm excited to welcome you to Developing Partnerships with Banks and Securing PRIs from Foundations with Dr. Michael Swack presenting. With this webinar, we're going to be looking at how native CDFIs can leverage investment from banks and program-related investments, PRIs, from foundations. We're going to look at both what banks and foundations are going to want to know about you, so how to prepare for meetings with the banks and foundations, as well as the terms and conditions of bank and PRI investments that you may get. This webinar is pretty much going to help you determine whether to pursue these investments and what to expect when you approach a bank or foundation for an investment. And we thought this would be another topic that would be helpful to all of you in your pursuit of capital. And just to kind of go through it, this webinar is the 5th webinar in a monthly series as part of the Native CDFI Capital Access Initiative some of you are participating in, which is funded by the Northwest Area Foundation. What's great about this webinar series, again, is that all of these topics discussed are going to be focusing on different ways to grow your capacity to access capital. And so to get us prepared, just for anybody who's not familiar with the platform we're using, Stephanie's going to share a couple of items with you about the GoToWebinar buttons and things like that. And I just want to let everyone know that we're going to be recording this webinar, so you'll be able to revisit it later if you like. So, Stephanie?
Good afternoon and welcome everyone to the webinar. So if you're unfamiliar with the GoToWebinar platform, we ask everyone to test out the question and answer section by just typing in, where are you from? What organization are you representing today? And throughout the presentation, please feel free to use this section of the webinar service to ask any questions you have and address those as they come up. Great, I see a few people are using it already, so I'll pass it back to Heather.
Great, thanks, Stephanie. I'm now, like I said, going to turn the webinar over to Dr. Michael Swack. He's a professor at the University of New Hampshire, where he has appointments at the Carsey School of Public Policy and the Paul College of Business and Economics. He's also the faculty director of the Center for Social Innovation and Finance. Dr. Swack is published in the areas of community development finance, community investment, and mission-related investment, which is why we thought he would be a perfect fit for this. Some recent publications include a comprehensive industry analysis of the CDFI industry for the CDFI Fund, and a book co-written with Charles Tansey entitled Capital Markets, CDFIs, and Organizational Credit Risk. And in 2000, he founded and continues to direct the Financial Innovations Roundtable, a program that promotes new approaches and policies designed to build the field of community development finance and increase access to capital for community development intermediaries. Dr. Swack received his doctorate from Columbia University and his master's degree from Harvard University and his bachelor's degree from the University of Wisconsin-Madison. So all that being said, it's my pleasure to introduce Michael Swack. And Dr. Swack, I'll turn it over to you.
Okay, thank you. Great, thanks, Heather. And thank you for inviting me to present today. And let me just start by saying that what we really want to look at, there's a lot of information. I'm going to go through some slides pretty quickly. But the basic thing I'm trying to get at is how can you prepare? And particularly we're looking at banks and program-related investments. And we pick those because we think those are two of the more promising sources of capital for CDFIs to approach, in part because there's experience and interest on behalf of both banks, frequently for regulatory reasons, and for foundations who are beginning to realize how they can use their resources and their assets better and support CDFIs. So we're going to look at both of them, and a lot of the focus for the next hour is going to be on how can you prepare? What can we learn from what people have done who've approached banks? What are some of the trends in the field? Let me stop for just a second. Heather, I'm hearing a little bit of feedback. I don't know if there's anything we can do to cut that, or whether if we have too many people on the line at once.
I'm not hearing any feedback. Stephanie, do you know if there's anything that you can do about it?
I'm not hearing it on my end, so.
Okay, I'm just hearing a little bit of an echo. So, all right, I'll go ahead. So we're going to look at how to approach banks, how to approach foundations, what to ask them for. But we're really going to start the first part by looking at the question of what are they looking for? What do they expect from you when you approach them to make an investment? So let me jump right in, and I have this first slide called Learning to Speak Bank. And in part, that's what language do they want to hear? What questions are they likely to ask? What sorts of responses will they expect from you? The first is that both banks and foundations often don't really understand this concept that CDFIs have, which is that we have two kinds of funds, operating funds and then financing funds, in part because particularly foundations, they're used to dealing with nonprofit organizations that are asking them for grant money. And so when you ask them to invest in you, they're often confused because many of them haven't done that before. And so what's really important in learning to speak bank and also to the foundations is to clearly distinguish from the beginning when you're asking for an investment that you really have two kinds of funds. You have operating funds, that's where you pay your people and your rent and things like that, and then financing capital. And they're two very distinct pools of capital that are kept separate. And when they're making an investment in you, they're investing in your loan fund in the financing side, and they're either investing debt or equity or making donations specifically to permanent capital. And so this is an important distinction because a lot of times when you're asking for an investment, they may be hearing that you're asking for a grant. So it's really important that you make that distinction right off, even by telling them, you know, we essentially have two pools. One is our operating funds, and the other is our financing capital, and we don't mix them. The financing capital, if you invest in us, is just for financing, and we won't be using that for operating. So that's the first distinction that you will want to make. Okay. So sorry, I went a little fast on that because it didn't work at first. So let's look at capitalization approaching banks. So here are some of the key topics we want to cover. We're going to look at the sorts of questions they're going to ask you. What's your capital structure? What sort of net assets do you have? What are some of the characteristics of the debt that you already have? That is, who's already investing in you and where do they stand? They want to know how secure are their investments going to be. They want to know about your history. When did you start? How quickly have you grown? What's your size right now? And they'll also want to know who are your other investors. What are your strategies? Are other banks investing, other PRIs, government agencies? Who are your investors? So they'll want to know a lot about what your capital is right now. What does it look like? Is it debt or equity? How secure is it? And how have you grown over time? And so if you look at this, if we look just at the loan fund one here on capitalization, we see that loan funds, you have both unsecured and secured loans. We'll talk about that. Subordinated debt and EQ2s. And EQ2, as we'll see, is a form of bank investment that's deeply subordinated debt. That means that all your other investors' money is protected by that EQ2, which is essentially first loss if there are losses. And then you have equity, your net assets, your permanent capital. And so when you're explaining to any financial institution, you will say to them, well, we have equity. That's the amount of money that's ours, our net asset. We also have subordinated debt, and you may have EQ2 investments from banks. And then we have generally unsecured loans and maybe secured loans. Let me mention that distinction right now, and we'll get back to it. Unsecured loans is when you have a number of investors, individual or institutional investors in your loan fund, and their security is the security of the pool. That is, you're not pledging any assets like housing or any other secure assets. You're saying you're secured by the pool, and everybody in the pool is protected equally through a concept called pari passu, meaning everyone shares equally. If there are losses, they share equal in those losses. But you have reserves and you have a balance sheet, and that provides a first layer of protection for them. So your equity is protection and your subordinated debt is. What we'll talk about in just a minute, though, is increasingly lenders, and I include banks in this category, are asking for secured loans. That is, they're saying, well, if you're making loans, we want you to pledge that security to us. We want to be in a senior position to other lenders to the fund. And as we'll see, this causes some problems for you, because if you're in a position where you've told other investors that they're all sharing equally, and the bank now that you're negotiating with says, well, we want you to pledge certain assets to us, it disadvantages your other lenders. And so one of the things that's important to consider as you go out raising capital and talking to banks is that they understand that ideally they would be in the position of the pool. That is, they're essentially an unsecured lender. There's no specific collateral being pledged to them, but they do have a subordinated debt, and in the case of most of the CDFIs, a substantial amount of equity. So again, this is a part of the explanation that you'll have to give to them when you're talking about your capital structure, and also what you're likely to hear back from them saying, well, can we have additional security as compared to your other investors? Ideally, your answer to them will be no, and you don't need to, because this will be quite secure, protected by our equity and any subordinated debt that we have. So the equity equivalent investments, I touched on that briefly, is something you can ask banks for. It was popular in the early 2000s during the financial crisis. A lot of that dropped off, but it is coming back. I'm seeing many more examples in the last couple of years of banks making EQ2s again. So this is something you can approach a bank about. An EQ2 appears on your balance sheet as a loan, but it's subordinated to all the other loans, and it's usually long-term. It's frequently up to 20 years long, and as we'll see when I talk about rates later, very low rates, typically around 2 to 3%. So it's good money to have. Now, when you go to the bank, and many of you are familiar with this, because from the CDFI applications you look at that, they'll often ask questions that relate to these concepts of minimum prudent standards. And so it's not unusual for the bank to ask questions when you go to them, and you would want to be prepared to answer these, where you ask, what is your deployment rate? So you might say, well, we're a fund of $10 million, and they'll want to know, well, how much of it is loaned out? Do you really have, what they want to know is there really a demand for your funds? Because before they invest, they'll want to know, if they're lending the money to you, are you getting the money out on the street? The net asset ratio, again, we talked about that briefly, and I'll go into it in more detail, but that gets to how strong is your balance sheet. Essentially, the net asset ratio for a nonprofit loan fund is how much equity do you have, and that equity protects their investment. And so they're looking for, in most instances, greater than 20%. They're looking for net income. They're looking for self-sufficiency ratio for nonprofits, meaning how much of your revenue do you generate from your own activities, typically through interest and fees earned on your loans. And again, they look at other ratios around operating liquidity. Do you have enough money to pay your bills every month? And your current ratio, current assets to current liabilities, again, that gets to an issue we'll talk about in a minute of asset liability management. Are you, do you have money that you're lending out? Can you afford, will you be able to afford to pay back your investors in a timely way? So we'll talk about each of these standards. The point of this slide is that there are a number of questions that banks in particular, more than foundations, but foundations ask these questions too, that will ask you to comment on your financial performance and how you meet the basic standards. These are CDFI. These on the slide here right now are the minimum prudent standard ratios established for CDFIs that you'll also see on your CDFI application. So you're going to get questions about understanding your net assets, and one of the things that they often are confused about when banks look at balance sheets and financial statements from nonprofit CDFIs is this concept of net assets, which they're used to seeing really on the balance sheet, assets equals liabilities plus. They're used to seeing net worth in for-profit companies. We call it net assets. And then they are also confused when they look at your audited statements about what are unrestricted net assets versus restricted net assets versus permanently restricted. These are terms that are probably on your audit and that are on your balance sheet and your financial statements that they'll have questions about. So, for example, most of you probably know that they're restricted and unrestricted net assets, but you'll have to explain this to the investor. So, for example, you may have you may get a grant from someone where they may restrict what you use those funds for. They may say you can only use it for one product, or you can only use it in one location. Or they may say it's restricted for the first few years to this location, but then it becomes unrestricted. Or it may be permanently restricted. A donor might say, I'm giving you this money, it'll be part of your net assets, but it's going to be permanently restricted because you can only use it in one state or one county. So this is going to be confusing and something you should be able to talk to the bank about when explaining your financial statement, saying, well, here are net assets. Oh, by the way, we do have some that are currently restricted or permanently restricted, and here's what the restrictions are. But this may or may not be a problem for you. The restrictions may be very simple ones that don't affect our ability to use those funds to protect you, or they may be more complex in terms of being long-term and restricted in certain ways. So here's a sample footnote of a temporarily restricted asset, and what you see here is that you can get something that is, the purpose could be, it can only be used for general operating as opposed to permanent capital. And then, for example, a temporarily restricted one says when it expires, and you'll see there the dates, December 2013, December 2014. But again, so you may have $700,000 in net assets, of which $500,000 in this case is unrestricted, and $200,000 is restricted. And $100,000 of that restriction expires at some point. Again, I'm mentioning and going into detail because these are questions that we've seen that banks offer. Banks, when they invest, look very carefully at your financial statements, often have a lot of questions, and those questions often relate to what the financial statements of nonprofit CDFIs look like and the way they differ from the way a bank financial statement might look. So moving forward, net asset characteristics. One of the things in terms of restrictions is that the board, your board, can designate assets be used for certain purposes. Not donors, they can, but in other instances the board might. So the board might say, we're going to restrict certain gifts that we have for operating reserves, or LLR, loan loss reserve endowment. So the board, even though it's not designated by a donor, can designate use. And this, again, will often appear in the audit as the board designates money that has to go to operating reserves. That'll appear in your audit. And this might come up where a bank will say, well, what is this over here? And you have to say, well, our board wants to make sure that we have the money set aside for operating reserves. And so that's why it appears as a designation from our net assets towards a particular purpose, in this case, operating reserves.
Well,
I'm going to stop here and see if we have questions.
Oh, yeah, Michael, we had one question. One was, how do we know what level of person at the bank to address? And how do we find the right person who is going to understand this?
Right. Good question, and in a sense, there's a two-part answer because, as we'll see, part of what you want to do is establish a relationship with a bank, and we're going to talk about that because there may be local banks where you're going to establish a relationship because, as we'll see in a moment, you're going to try and negotiate a line of credit, maybe one way you can use banks. In other instances, you may be dealing with the CRA division of a bank, in which case their purpose is going to be looking at how they can make investments, and they're more likely then to be involved in an analysis around investing in you for as part of a longer-term investment as opposed to a shorter-term line of credit. So part of it is building relationships. One of the things I suggest is you should establish a relationship with the appropriate person of the bank before you even approach them for any loan or any other purpose, grant, loan, whatever. Who to approach? In most instances, the starting point is going to be the people in charge of community reinvestment. And even within that, you're going to see some differences. So, for example, in banks, you'll often see that the person in charge of community reinvestment is someone whose experience is in their compliance division. Essentially what that tells you is the bank is just concerned about complying with the regulation. Typically, and there are exceptions to this, but typically in banks that are serious about their CRA lending, they'll have someone with experience in lending who actually runs the CRA division. So here's the suggestion. When you're getting to know, when you're thinking about which bank you might have a relationship with, make an appointment, go and talk to the people there. You can start with community reinvestment, but the starting point should be just to sit down and say, here's who we are, here's the loans that we make, here's a little bit about us, here's something about our financial strength. That is, establish the relationship before you ask for anything. Tell them what you do, and then find out what they're doing in the area of community reinvestment as well. So the first meeting is really, here's who we are, and can we learn more about how you approach your community reinvestment responsibilities, and then that will give you some vision into what the possibilities are in terms of working with the bank. Other questions? Okay. Here's just a quick idea you're probably familiar with, but the net asset ratio is your total net assets divided by total assets. So if your net assets in this example are 7.8 million and your fund is 29 million, that means you have 26.7 net assets or equity. You have equity of 26.7%. And again, this is money that's available to protect the investors. In the case of losses, first you expend your loss reserves, then you would go to your total assets before there would be any losses allocated to investors. From what I've seen, and Heather sent me some information, most of the native CDFIs have pretty healthy net asset ratios. That means they have fairly high, in excess of 26%. Most of what we are seeing is 40% or even more. And what that suggests is you have very strong balance sheets. What it may suggest is that you could do higher leverage. That is, if you have a 40% net asset ratio and your historic losses are less than 5%, and you're setting aside reserves for that, what that suggests is you can probably leverage your balance sheet more, and that's good in terms of talking to banks. That is, you can go and say, look, we have a net asset ratio of over 40%, but we've been in business 15 years, and historically our losses are 3%. Therefore, we're asking you to invest money in us, and that money will be very safe based on the strength of our balance sheet and also based on the fact that historically we've had very low losses. These are the sorts of things that banks are going to want to hear. This is what they'll look at. What are your total assets? What are your historic losses? How are we protected? So the net asset ratio does that. Sorry, I'm just having a hard time. The slides are moving very slowly. Just a variation on the net asset ratio is if you had restricted assets, you could do an unrestricted net asset ratio. That's where you just are doing your unrestricted net assets is total unrestricted net assets divided by total assets. This again gets back to the point of if they're concerned that certain restrictions may make it less safe for them to invest, you can give a ratio of, well, most of our net assets are actually unrestricted, and here's the ratio of our unrestricted net assets. Just to give you a sense of the industry as a whole, so you see where you fit in, you can see that the CDFI industry, irrespective of size, so each of these bars represents size. So the red is, those are funds under 10 million. The blue is 10 million to 50 million. Green 50 million to 100, and orange over 100 million. What you see here is that actually, irrespective of size, CDFIs tend to have very strong net asset ratios. That means, again, not necessarily good or bad per se. One could argue that these are higher than they need to be. If you've been lending a long time, and if you have a high net asset ratio, meaning 44%, then you could probably leverage more, meaning you could borrow more. Just for sake of comparison, a conventional commercial bank would probably have a net asset ratio, or the equivalent of what they call in banking net worth or capital ratio of as little as 7 or 8%. So you can see banks are very highly leveraged, CDFIs not so much. And I think one of the reasons in this webinar we're talking about going to banks and to foundations for program-related investments is to tell them, is to say, look, when you look at our finances, we have a lot of money in net assets, and we have a good history of lending. We could use more money. We can leverage more money, and your funds would still be safe. Again, if you look at net asset ratio, again, very, very consistent by loan fund sector. So this says, are you primarily a micro-enterprise lender? The blue is business lenders. You can see the chart. Again, what this tells us is irrespective of what you lend to, that CDFIs have high net asset ratios, meaning that they have lots of net assets to hedge against risks. Now, I would point out that the highest one here, you see the 55% is business lending. And again, that, along with micro-enterprise lending, is typically because that's seen as the highest risk sector. It tends to have less security. That is, when you get security, it may not be worth as much as opposed to real property. But again, even on the commercial real estate and housing loan funds tend to have very strong net asset ratios. Okay, then asset quality. One of the things that a bank will look at is they really want to understand and be comfortable with not only your asset quality, but the processes that you go through for making these loans. So don't be surprised when you go to the bank if they say, you know, what we'd like to do is look at your policies, in addition to your financial statements, to look at your policies and procedures and your performance over time. And so what they'll say is, well, it's good that you have a balance sheet. We can see that you have lots of assets and you've set aside reserves and all that. But tell us a little bit about how you operate. How do you make decisions about loans? How do you measure your portfolio performance? Who oversees the management of the portfolio? What role does a loan review committee or does your board play? And these are all questions that are attempting to get at asset quality. You may look good on your balance sheet, but tell us a little bit more about how you actually operate. And again, banks are very interested in this. They want to know is, do you have a good process for making loans and making decisions? Do you have performance measures that you look at? We'll get into each of these in just a moment. And do you have proper oversight from boards or appropriate committees to ensure this kind of quality performance? So let's break down each of these into a few categories. The asset compositions. They want to know, okay, what type of loans do you make? Are they business loans? Are they housing loans? Do you take security on them? Tell us a little bit about your loans receivable. what loans have you made? Do you get a repayment on time? Where do you put your cash when when it's not deployed? Where do you keep it? What other assets do you have besides your loan fund assets? So they'll want to know a little bit about your fund and its assets. And they'll want to know about the decision-making process as well. Do you have standard underwriting when you make business loans, for example? Are there clear directions on how approvals are made? Do you have good documentation? They may even say, can we see a credit file? Can you show us an example of a credit file? Do you make exceptions and do you document them? So again, banks are very concerned with this. They're saying, well, if we're going to make an investment, let's look carefully. We're essentially underwriting you as an investment like we would other investments. And so you should be prepared to be able to describe not only your financial statements, but your processes of decision making, your documentation and files that you keep on everything, and how you make exceptions and when you make exceptions. And they're also going to want to see the documentation of that performance. So do you provide monthly or quarterly statements that track delinquencies, that track loan terms, concentrations? Do you have portfolio management policies that limit, for example, how much is loaned to any one borrower? Do you have risk ratings for each of your loans? Do you have loss reserves that are based on looking at the risk of each loan and setting aside reserves for each loan, particularly as it may enter a higher risk category? So you're going to get questions from banks about how you manage your portfolio and how you make decisions. Let me stop for a minute. Other questions? Okay. And again, the sort of standard reporting, and most of you have this, where you report what your losses are and charge-offs and things like that. But these are questions banks ask. They'll say, so how many losses? What's been your historical loss ratio? And how much have you charged off in the last few years? Again, a lot of dealing with banks for investment is about preparation. Can you answer their questions? Again, think of it this way. They're underwriting you in a way that they believe that you underwrite, and that you probably do underwrite, each of your loans. There'll be questions about allowance for loan loss ratios. So they'll want to know, what is your loan loss reserve? How have you figured it? How does it relate to what your losses have been in the past? What's your past due ratio? They'll want to know, is your portfolio mainly paid on time? Can you tell us about any changes that have occurred in that over the past year or two? What charge-offs have you had? How many did you have last year? How many did you have the year before? Is that going up or down? What's your method for calculating charge-offs? Do you have a formula for doing that? And so again, they'll want to see if you start with the loan loss reserve for the prior year, and then look at what losses occurred, and then look at how you calculate your reserves for this coming year. Again, what they want to know is that you have a process. You look at these things, it's based on data you collect from your borrowers, and that these are ratios, these are reserves, these are what you set aside that makes sense based on the experience of your fund. Okay, and this is just a sample. These, you can refer back to this, but this would give you an example of what you might present to them. So for a bank, they'll say, can you give me a sample portfolio performance that just looks at a few of your key factors over the last 3 years? And so you might give them something that looks like this, saying, well, yeah, here's our past due performance. This is the percentage of the portfolio. See, so this is the kind of documentation they'll look for. Can you produce a report for them that gives them some sense of what your performance has been on some of the key issues, that you've tracked it over time, and they can see the direction it's going, if any. So typically having a sample portfolio performance document that gives end of year for 3 years would be something they would look for, and that would report each of these which we have spoken about. again, if we actually look at, this is data that we've taken from a large sampling of CDFIs in a couple of the studies that we did, and what we can report and say to banks is, look, as a whole, our field is done as well as you. It's not just us, but our field actually rivals conventional financial institutions in terms of the types of write-offs and financial performance that we have. And an interesting factor that I haven't put here is that over the last 5 years, CDFIs as a whole have outperformed banks in several financial categories, including return on assets. So again, having this information, and I have a reference here you can come back to, we have ideas of reporting definitions and guidance on a paper that was coordinated by OFN that's available on their site, and I give you the information here. And rather than going in great detail, I'm going to go through these slides quickly. This is just getting to the issue of using standard definitions. One of the things banks often say is, we have a hard time reading CDFI financial statements because you guys all define things differently. And so what these slides have, and it was the previous link on the previous slide that gives you more specific information, but what I'm suggesting here is use the set of standard definitions recommended by a group of CDFI CFOs. And so you're talking about that we really do have standardized terms when we talk about past loan due and what that means. And we all measure the same things in terms of, measuring 30 days past due, 60 days past due, and 90 days past due. And again, this is an example of how you might report something like that using those standard definitions. Okay. Here's another question that a bank is going to ask is where do you put your idle funds? In some ways, they hope the answer is, well, with you. But they do have a question saying, so if you have a fund of $10 million and a 70% deployment rate, meaning at any given time 70% of it is out in loans, where's that other 30%? How do you protect it? Where is it in an investment right now? And also, this is where you might raise with a bank the question of, well, we have our investment funds with you, or maybe with a different bank, but with you, we might also ask for a line of credit. One of the things I suggest to CDFI is a good starting point with a bank. So if you keep an account with them, and if you maintain your idle funds there, then you should have a line of credit negotiated with them that would enable you to use it at any time. Again, the thing about deployment is deployment rates vary. There may be times when you're loaned over 70% or 80%, and where you may have a good opportunity coming to you, but you may not have new investment money coming for another 6 to 12 months. So you may have a very high deployment rate, and you'll want a line of credit so that you can take advantage of any opportunities. On the other hand, there may be times when your deployment rate's very low. Say you get a big chunk of funds from the CDFI fund. Well, if you measure at that point in time, the day after that comes into your account, then obviously your deployment rate's going to be lower because you just got that money. You haven't had a chance to get it out onto the field yet. They're going to ask you a bunch of questions about management. The banks are really big on this because what they really believe is we want to know that the people who are in charge of our funds know what they're doing. And so they're going to ask you a set of questions about what is your strategy, and give us a little bit of the history of your lending. Explain your current governance structure to us. Who's the CEO? Who makes decisions about loans? Who's on the loan review committee? Who's on the board that provides the fiduciary oversight for your organization? Tell us something about the experience of your management and staff. Explain your information systems and how you ensure that you have the documentation and do the proper reporting. So again, be prepared to answer questions about your management when you go to the bank. Be prepared to talk about your historical performance. Again, what they're going to want to know is, tell us what's happened since the beginning. Are your operating results getting better? Are your revenues increasing each year by and large? Are your expenses staying constant? Are you developing new products? So they're going to want to know questions about your financial performance and your earnings. They may or may not ask, this is something you'll want to know, but they may ask about your self-sufficiency ratio. Again, we talked about that a little bit earlier, but what's your earned income divided by your total adjusted expenses? Essentially what this says is how much of your annual operating costs are covered by income that you earn typically from interest on loans and fees. Again, just to give you an example so you can see where you compare in the field with others, you can see that for CDFIs, it is generally true that the bigger you get, the more your self-sufficiency ratio increases. It sort of makes sense. If you have more loans out on the street, that means you have more earnings, and generally you're going to realize some efficiencies in operation, and you'll have a greater self-sufficiency ratio. Again, this is by sector, so you can see if you focus on business lending or on housing. Again, not surprisingly, microenterprise has the lowest self-sufficiency ratio because proportionally it costs just as much to make a small loan as a large loan. If you're making a lot of small loans, it's going to be more expensive. And again, this is contributed revenue to operating revenue by loan fund asset size. Again, what this shows is that more money comes from donors, so contributed means donated revenue as a portion of operating revenue. Again, as you get bigger, that amount typically goes down. You're less reliant on donors the bigger that you get. And again, by sector, again, microenterprise, not surprisingly, has the largest contributed revenue because it has the smallest amount of earned revenue. Last set of questions that they're going to ask around your performance is they're going to look at the liquidity. They want to know on the operating side, how do we know you're going to have enough money to operate year to year if you're dependent on grants? And so you're going to have to talk to them about your operating funds. Where do they come from each year? How reliable are they? How diverse are they? And also liquidity, do you have the ability to meet your commitments? And in particular, I want to point out this asset liability matching. This is where you're most likely to get questions because they'll want to know the loans that you have. When investors invest in you and they invest for 5 years, are you investing for 5 years? Are you investing for 10 years? If you're investing for 10 years, how do we know that you'll have the money available to make new loans? How do you know you'll have actually the money available to pay us back? If you're lending long, you're not going to get paid back in time to pay us back, is their concern. So essentially, they're going to look at how do you do that? How do you make decisions about loans? How do you assure that you'll have enough money on hand to pay us back when our loan is due? I mentioned earlier they're going to look at deployment. Typically, they're going to want to see that you're pretty well deployed. That is, investors aren't inclined to invest if they see that the money that you have right now is not invested. So this tells you how you calculate a deployment rate, but it's essentially a deployment rate is all the money you have available to lend, and then you look at how much of it is actually loaned out. This is the specific equation for it, but again, quite a bit of variability with CDFIs. 80% would be a very high deployment rate. Once you get below 60%, that's typically considered to be relatively low. The question is there sufficient demand for your products if very little of it or too little of it is out in the streets? All right. So now we're going to the banks, and how do they structure loans to CDFIs? Well, here are some of the things that they look at and that you're going to look at. How long will they lend you money? as we'll see in a moment, typically banks don't lend for more than 5 years. If you're a business lender, that's probably okay. If you're lending for real estate, that's relatively short. So the money that's paid back, are they amortizing it? That is, do you have to pay a little bit every month or every quarter? Or is there a balloon payment? You can use it for a while and have a large payment at the end of, say, year 1 or year 3, or even in some instances with banks, you'll see, we'll make a loan for 5 years. It's all due at the end. You don't have to pay us anything back in between. Makes it easier to manage. Are they going to ask for specific security? Or is it going to be pari passu, like we mentioned earlier, meaning they're in with the pool? What's the pricing? Are they going to charge you 1%, 2%, 3%? I'll, in a moment, give you some ideas in terms of what the standards are so that you'll know what to ask for. Well, they ask for covenants. And look just below. Covenants may be performance covenants. They may say, we're going to lend to you, but you have to promise that your net asset ratio will never go below 30%, or that your allowance for loan loss will always be at least 5%, even if your losses are less than half that. Or they may say, in order for us to, for your loan to be current with us, you have to have an operating surplus. You can't lose money in any given year. So it's fairly typical in dealing with banks that they'll ask for these covenants. Don't agree to a covenant that you know you can't meet, and don't agree to a covenant that doesn't make sense to you. One of the things people often don't realize is that these terms are negotiable. When you sit down with a bank, you don't have to take their standard to begin with. They say, well, here's the way we do it. You should go in prepared saying, here's the type of investment we'd like. We'd like a 10-year investment. We'd like it at no more than 2% interest. We'd like a repayment schedule that's repaid at the end. We're willing to have covenants around net asset ratios. We currently have a requirement on our own of not going below 30%. But know what you want and ask for what you want. These are the things they're looking for, but you can go in with a specific request and not simply respond to what they say as a standard. The point is it's negotiable. Questions?
There's one question. What is the best practice to ensure that loan capital terms are matched with loans receivable terms?
Yeah, that's a good question. And again, it gets to asking for what you need. So that is, when you're making a presentation or a pitch to a bank or a program-related investment officer at a foundation, you need to describe to them to say, look, here's what makes sense for us. When we look at asset liability management, here's the type of loans we make, here's the term, here's the interest rate, and therefore the best investment for us is one that allows us to match our sources of funds with our uses of funds. So if they come in and propose something that's clearly out of line with the type of loan you make, that you really need to step in and negotiate that. It doesn't make sense to accept funds that don't really fit with the type of lending that you're making. And so the argument you have to be prepared to make is to say, here's what we make. Here's the loans that we make. Here's the term. Here's the interest rate and all that. Our investments, we want to align with that so that we're able to easily make the loans that are the loans that serve our market. Is that okay? Does that answer the question, or is there a follow-up? All right. So I'm going to go through. I'm sorry, go ahead.
Oh, you're all good.
Okay. So CDFIs, how they're capitalized, again, we went over this in the beginning. Just this gives you a sense of what the CDFI field looks like so that you can compare yourself. This is a different loan funds. Look at the red if you're a loan fund. I threw in credit unions as comparison, but the red shows loan funds. So again, what this shows is that the typical capitalization by CDFI is about 40% equity, about 55% borrowed capital, meaning from PRIs, private individuals, banks, that sort of thing, and a small amount, about 4.2% from EQ2s. Again, if you look at urban and rural, you'll see, not surprisingly, that rural has a much higher capitalization, so they're much less leveraged. In part, that's because there are fewer opportunities. And in a sense, you'd say, well, rural, but the rural really they're less highly leveraged because there are fewer investors in rural areas. You're going to get an investment from a bank. One of the problems in getting investments from banks now is over the last 10 to 20 years, the banking sector has become much more concentrated. There are fewer banks. In the past, if you were in a rural area, you might have gone to a rural bank. I know in the state I'm in, many of them are gone now. They just don't exist anymore. The larger national banks tend to lend in an area that they call their footprint. If you're not in the footprint of one of these banks, meaning they don't have branches in your area, then they're not going to be interested in making an investment at you. It doesn't help their Community Reinvestment Act cause. So part of what you see here is the issue of rural, is that there are fewer opportunities, there are fewer foundations, and there are fewer banks to lend, and therefore you see that they have higher capital ratios. That's not necessarily a good thing that they have stronger balance sheets in this case. It's more a result of their circumstances, and you may find yourself there. Again, capitalization by loan fund size, same thing. What we see, again, if you look at the far right, the bigger you are, the more highly leveraged you are. And again, that ties in with what I was just saying. Bigger CDFIs tend to be in major urban areas. They tend to have more institutions, foundations, and banks that invest in them. Therefore, it's more easy for them. It's easier for them to leverage funds. So again, what you see here is a picture that's pretty much what you would expect. All right. So sources of capital and borrowed funds. So we're focusing on banks and program-related investments here. There are others, but we're focusing on the two in the red. And just so you can see the sources of funds, that banks are still, by percentage, the largest source of borrowed or leveraged funds from CDFIs. The federal government, through the CDFI fund and other related programs, are second. And then foundations through PRIs are third. So really, we focused on these top two. Most of you are familiar with the federal programs. Banks and foundations are the other two top sources of funds. The program-related investments, then, originated by charitable funds. There are a lot more foundations doing PRIs now. 10 to 15 years ago, it was only the major national foundations. Ford had been doing them for a long time, the MacArthur Foundation, the Kresge Foundation. I think one of the real possibilities for the CDFIs on this call is that increasingly local, community, and regional foundations are figuring out how to do PRIs. And one of the things that really pushes them further is that if they meet CDFIs that ask them for investments. So one of my pieces of advice here is get to know the local foundation. Do you have a board member who has a connection with a board member there? Are you familiar? Has a foundation funded some of your other programs? Do you have a program person you can talk to? Find out if your local foundation has a PRI program right now. If they do, find out what the terms and conditions are. If they don't, set up a meeting to begin to talk about how they can invest in your CDFI. And there's some good examples of local foundations which you can use that are beginning to do PRIs. In fact, there's a whole association now called the PRI Makers Foundation, which is a group of foundations that make program-related investments and share information with each other. So sample rates and terms for both banks and PRIs is probably one of the slides you've been waiting for, which is, all right, so what do these investments look like? So from a foundation PRI, typically they're between 1% and 4%. They're fixed rate. They're unsecured, meaning they don't ask for any special security. They're in at that pool. They're part of the pari passu, and up to between 5 and 10 years. Again, the starting point is ask for what is best for you, rather than saying what do you offer. Saying we're looking for a PRI. What we hope to get is 1% for fixed rate for 10 years, and then go from there. EQ2s, which we talked about, which is a form of bank investment, generally 1 to 3%, fixed rate, usually at least 5 years, often longer, with a rolling component, meaning that they'll roll it over for another 5 years. But they can be as long as 15 to 20 years even, and again, unsecured. In fact, remember we said earlier, these are subordinated to all other debt. Banks can count this towards their CRA investment, but this EQ2s are very flexible debt from banks. It's something worth pursuing. More standard bank debt that's not EQ2, again, tends to be less in terms of term, 5 years as opposed to 10 or 15 years. If I looked at the bank loans that I've seen over the past 18 months or so, on average, they're between 5 and 7 years in length, between 2 and 3.75% interest. Lines of credit I talked about, which you should pursue if you don't have one, and those can be at variable or fixed rates. Again, with the banks, ask for what you need. So ask for lower rates, ask for longer terms. They may counteroffer, but start with what works best for you. Finally, there are in different places in the country structured capital pools. This is often a capital pool that might be comprised of a number of banks. So there are, a number of instances, and if there's one in your serving your region or community, you can look into this. May not be worth trying to start one on your own unless you're already working with several banks. But these are capital pools that have multiple investors, often multiple financial institutions, and tend to have rates that are fairly similar to the bank rates that you would see here. Just to give you a sense of the cost of borrowed funds compared urban-rural, what this shows you is the cost of capital now, again a comparison, is about 2.6% for CDFIs. The average EQ2, even less, about 2.25%, and this is the average size for CDFIs in terms of how big an EQ2 might be. So in a rural area, you might get an EQ2 of just under $1 million or so. That would be pretty standard in terms of what you might expect and what you might ask for. Again, this is just breaking down, and we don't have to spend a lot of time. You can come back to it, but this is a chart that tells you a little bit about the cost of borrowed funds by loan fund, asset size, and service area. Again, what this tells you, if you look at the far right, the cost of an EQ2, if you're a fund of under 10 million, there's not a lot of great variation there. Again, the bigger funds in this case actually pay a little bit more, but their average EQ2 is of a bigger size as well. And again, the other shows you urban and rural by size of your fund. So if your fund is under $2 million, under $10 million in a rural area, the cost of an EQ2 is about 2%, and the cost of borrowed funds from a bank just under 3%. So this is data just collected in the past years. This will give you a pretty good sense of what you might ask for. So that's a little bit about, what do banks look for? How might you approach them? What should you ask for? The same with foundations. How can you reach out to them? Explain to them PRIs. What are the rates and terms that you might expect for PRIs? So let me see if there are final questions here or clarifications that people might want. Okay, what I would, a lot of times you take a look at this again and it sinks in. If you have questions that come up tomorrow or a few days from now, feel free to send me an email. That was on an earlier slide, but it's michael.swack@unh.edu. Heather knows how to get in touch with me as well. A lot of times this takes a little while. There we go. Sometimes it takes a little while to sink in, but I really do welcome questions, and I can tell you I often get more questions the day after the webinar than I do on the day of the webinar. So please feel free to contact me at the email address below. Heather, let me turn it back over to you then.
Perfect. Thank you, Dr. Swack, for that presentation. I think it was really helpful. I actually learned quite a bit with taking notes throughout, too, so thank you. And thank you, everyone, for participating in this webinar. I hope that we provided information that will be useful to you and your organizations. I wanted to make sure and point out that a very brief survey, again, should pop out when you close this webinar, and please fill it out. Like I said before, it helps us track this webinar series and make sure that we continue to improve as we move along and just provide you a quality product. Also, our next month's webinar is going to take place March 23rd at noon, and Crystal Cornelius is going to be discussing how to talk to investors, and so it's going to kind of, again, go along with this theme that we've kind of covered today, too, and we're going to send out more information about that soon. So have a wonderful rest of your day, and thank you again.